Welcome to the Unit 5 AP Econ 2020 semester review for macroeconomics. In this unit, we're going to cover chapters 32 and 33 as we close out the macro review for this year. So we're covering chapter 32. Let's jump right in and looking at labor markets, unemployment, and inflation. And then we'll take a deeper look at inflation in chapter 33, where we look at inflation, disinflation, and deflation. So the nature of unemployment. There are a couple of types. Frictional unemployment, about 1% of our unemployment numbers is people that are between jobs, really looking for a new job and haven't found one yet. Structural unemployment is about 3%. So this is when you don't have the skills that you need in order to get a new job in the economy. So if you're structurally unemployed, a lot of times there's more people seeking those jobs than there are jobs available. And that would be structural unemployment. So if you think about it in terms of the nature of unemployment or the natural rate, usually we add a couple of percent on top of this. So 1% for frictional, 3% for structural, and about 2 to 3% more on top of that, for example, would lead to about a 6 or 7% unemployment rate would really be our standard today in terms of what we see. Now, prior to this pandemic, we saw a natural rate of unemployment that was really low, 3.4, 3.5%, and now we're seeing that above 4.5, somewhere around in there. So still not of major concern, but definitely keeping an eye on it in terms of the impact that it can have. Now, let's talk for a second about structural unemployment, that aspect. What can cause some of this structural unemployment? Minimum wage is a good example here of what can cause a structural unemployment increase, and that is more people will be out of work if you have minimum wages. Now, all of our states have minimum wages, at least the national minimum, but the idea here, from an economic point of view, looking at this from an economic one, not a political one or a government one, but the idea of a minimum wage is that if a business has to pay more for each worker, they're going to be more inclined to hire fewer workers because of how much they are paying for each of those workers. The same is true when members that they're hiring are members of a union. They deal with collective bargaining. Again, they're going to win higher wages, higher benefits, other resources, and as a result, businesses are going to be less inclined to hire as many workers as they might need because they're going to hold back because of the concerns that, hey, I don't know how much I'm really going to have to end up paying for these particular workers. Maybe instead of hiring 15, I should hire 9 or 10 people as a result of that. Efficiency wages is another one. This is the Costco effect. Costco pays higher than the minimum wage for their workers, but they hire fewer workers as a result of this. They also know that those workers are going to have an incentive to work harder and also stay longer. They're not going to be as likely to leave and go get another job as a result of that. And then obviously government regulation is going to have an impact on structural unemployment, leading to a higher structural unemployment rate as a result of any regulatory aspects that the government is requiring businesses to do. Again, they're going to pass that along to their hiring practices as a result of this so that they don't have to worry about whether they can make ends meet based on all of the additional fees and costs that they're paying for these workers as a result. Okay, so the natural rate of unemployment then is going to obviously fluctuate around the actual unemployment. But the idea here is that there is going to be deviation. Anytime you have cyclical unemployment, meaning you have recession where you're going to be moving left of negative output gap or left of LRAS, or inflationary gap, a positive output gap where you're moving to the right of LRAS, you're going to have some deviation from that actual rate of unemployment from the natural rate. And so what can change the natural rate of unemployment? Well, a number of factors, including the labor force characteristics. lowering the age at which people can participate in the labor force, expanding labor market institutions, what regulatory requirements and government policies are at work here can also affect the natural rate of unemployment. And productivity. Even the manufacturing facilities in the United States today, look at Ford, GM, Chrysler, they're using more computers and they're using more robots and other resources than people on the assembly line. The jobs that they're creating are jobs that are managing these technologies, managing these computers and robots and that sort of thing. So it does change the natural rate of unemployment as a result of what we see here. Now, it's important to note that in terms of the actual level of real GDP and potential GDP in terms of output creates what we call an output gap. This is the idea that what is potentially possible is due to the actual unemployment rate, and the idea here is what is your potential versus the natural rate of unemployment. So it creates an output gap. The idea here, if we have real GDP and our potential is beneath real GDP, then chances are our unemployment's going to be higher. And if potential output is actually greater than real GDP, that positive output gap, then as a result of that, unemployment probably going to be pretty lower than what our natural rate of unemployment would be. So that's where we kind of think about it. And again, the College Board is really keen on this idea of output gap. Negative or positive in terms of using those terms, not using inflationary gap or recessionary gap as much anymore. So an inflationary gap would be a positive output gap, a recessionary gap would be a negative output gap, but the idea is the same. If you have a positive output gap, your unemployment rate is going to be much lower than it would be at the natural rate. If you have an output gap that's negative, a recessionary gap, you're going to have an unemployment rate that's higher than the natural rate because of the fact that you're in recession. Therefore, businesses are closing, they're laying off workers, your unemployment is going to be higher than it would be at long run, being at full employment. So Okuns Law actually says, how do we tie these two things together? Well, we look at the output gap in terms of GDP, and we look at this idea that as real GDP grows by percent by percent, as real GDP grows by 1%, the unemployment rate actually drops by a little less than 1%. And you don't need to know the formula here, but you do need to know that Okuns Law, which I've never seen a question actually called Okuns Law, but I have seen a question talking about how real GDP affects unemployment. And that is that if your real GDP is growing by a percentage, the idea is unemployment is falling by a little less than 1%. If real GDP is growing by 6%, your unemployment rate is falling by a little less than that 6%. So think of it as it's not a 1-to-1 ratio, but the idea is the same in that there is an inverse relationship in growth in real GDP and the falling of unemployment. In the falling or the recession of GDP and the rise of unemployment. So there is a relationship there that is happening. Now, a couple of things in terms of wage adjustments. We know there are some misperceptions about equilibrium wages and how that kind of takes effect. We know sticky wages are in there in terms of reducing the wages that people are paid right away because of the advantages business may be taking at the time in order to improve their profitability or their profit margins in the short run, but in the long run, sticky wages aren't sticky anymore. And by the way, the important thing to note is that sticky wages certainly aren't sticky when you have really high inflation. Those sticky wages, they get much less sticky as inflation rises even faster. And that's where you get into things like menu costs and shoe leather costs and that kind of thing in terms of the inflationary pressures that are at bay. But the idea here is there is a lag. Wages do adjust slowly and more slowly than a lot of other things, other resource costs that are out there. Now, a couple types of inflation, and we'll get into more of this in the next chapter, but it's important to note demand pull inflation is this idea that AD, aggregate demand, is actually shifting to the right, causing the price levels to rise through a pull, demand essentially pulling up inflation as a result of wanting more product. Now, in cost push inflation, you've got resource costs that are going up, and that's essentially pushing costs up as a result of that inflation. So SRAS shifting left there is going to cause aggregate price level to rise through stagflation, but that's leading to cost push inflation, which is essentially what we're talking about there. Stagnant wages, higher inflation, all of that's going to be taking place in terms of a stagflation in that particular type of output gap that you would see there. So the relationship then leads us to the Phillips curve, which is this idea that there is an inverse relationship between unemployment and inflation. When inflation is rising, unemployment is falling, and when unemployment is rising, inflation is falling. And in the short run, there is that inverse relationship between the two. So what does that mean for us in looking at in the long run and in the natural rate of unemployment? And that is this: that the Nehru, or what we refer to as the non-accelerating inflation rate of unemployment, or again equal to the natural rate of unemployment. The idea here is that the unemployment rate it's essentially Nehru is the unemployment rate at which inflation doesn't change over time, and that is what we would see in this particular mapping when we look at full employment, when we look at the long-run Phillips curve, the natural rate of unemployment. Over time, in the short run, that may change, and inflation may have an impact on those sticky wages. But in the long run, we know it doesn't. And inflation, this unemployment rate at which inflation doesn't change over time, isn't going to have as much of an impact as it will when we are in a positive or negative output gap in the short run, and looking at that driver. So in the long run, all of these things, again, sticky wages aren't sticky in the long run. Well, the idea is that the Nehru, or the natural rate of unemployment, isn't impacted by inflation in the long run either. Okay, so the long-run Phillips curve then showing that relationship in terms of the expectations that we have. Why is the long-run Phillips curve vertical? Because, again, in the long run, we know that there's no trade-off between unemployment and inflation, and that's essentially what we see here illustrated with the vertical line. The short-run Phillips curve then, just a couple of key graphs before we close out this chapter. We can see here the inverse relationship between inflation and unemployment. This is better told in terms of a shift in the curve. Remember, the idea here is that we see changes that are happening in labor institutions, in government regulations. What is happening if we have a resource gap that's leading to a recession, a negative supply shock, if you will, that we have kind of a graph in graph here. But the idea is an SRAS curve shifting to the left is going to lead to a higher price level, but real GDP is falling. In that respect, and only in this respect, we would see a shift in the curve, because you have inflation and unemployment both moving higher as a result of this. So this is a shift in the curve. Now, what have we seen over the last 11 years? We've seen actually inflation and unemployment falling. So we've seen a low unemployment rate, one of the historically record lows in terms of the unemployment rate, and inflation keeping pretty low as well. That's a shift inward of this short-run Phillips curve. So that would be an inward shift or leftward shift as a result of that. And then we know that in the long run, that there's no relationship between inflation and unemployment, thus giving us the natural rate of unemployment in the long run, essentially not impacted by inflation, but the idea is it's a vertical line. Okay, so let's look at inflation while we're talking about that, and its relationship to loanable funds and government spending, an important aspect here. So let's first start off by talking about the loanable funds market. So this is hypothetical, but the idea is that in terms of whatever availability of funds is out there, it is basically looking at the market of that money. Think of it as banks have this cash to loan out, essentially creating the money out of what they've took in from deposits, and then what they don't have to keep in reserve requirements, they can basically loan out. So this creates the loanable funds market. and as part of that money creation that's out there. And borrowers obviously want to borrow the money, and lenders want to loan it out. And so essentially we get this idea of a loanable funds market looking at an upward sloping supply curve, downward sloping demand curve, meeting at equilibrium with a real interest rate, again, no inflation here, a real interest rate at R and a quantity of loanable funds at Q. Now, the important aspect to note with this is that as we start to see what we call the crowding out effect, the demand is going to shift because government wants to borrow money in order to get the economy moving, to shift aggregate demand. And to do that, they need to borrow money that they're going to be competing with businesses that are borrowing money in order to pay for these sorts of things. So in order to do that, they're going to be crowding out, if you will, by shifting this demand for loanable funds. They're crowding out private investment. Think of this as kind of slowing down the PPC. Now, what economy really wants to slow down the PPC? None. But that's exactly what's happening when you're crowding out private investment and business from being able to borrow the money it needs in order to expand its innovation and growth and technological resources. And that's exactly what we see here in terms of this. Now, how can we shift the supply curve is a very good question. And that's when households decide to save money instead of spending it. We're seeing some of that with these stimulus checks that are coming out from the coronavirus pandemic. There's some leakage, of course. They're paying off bills. They're paying their basics, right? Paying off their rent or paying their credit card down and trying to get caught up on their bills. But the idea is this would shift the supply of loanable funds. And as a result of this, what it's going to do is increase the supply of loanable funds for the amounts that are being saved, that households are saving, keeping the money in the bank. And this is essentially lowering the interest rate and increasing the quantity of loanable funds at the same time. So what we see here is a lower interest rate and a greater quantity of loanable funds because households are saving rather than spending that money. Now, another key graph to point out that we talked about was this crowding out. So you can see here demand, again, shifting to the right, leading to a higher interest rate, but a greater quantity of money as a result of this. But again, you're paying a higher rate for that. So what it's doing to businesses, if business wants to borrow the money, they're going to pay a higher rate in doing so. That's going to stifle some innovation. That may keep some businesses from saying, hey, wait a minute, maybe we really don't want to do this. And that tends to stifle the PPC from pushing out to its full potential. So you might not reach that point D that wasn't feasible in the beginning quite yet because you haven't had the money or resources based on private investment to be able to do that. All right, so let's talk about the inflation tax. So this is if you think about the real value of money and then you add inflation to it in terms of what people are actually paying for the goods and services that they're buying, it's essentially an inflation tax. It's essentially the inflation on top of that real value of money that people are paying. And then these resources, if they're captured by the government, is essentially what we would call a real inflation tax. The real value of those resources, essentially the inflation rate times the real money supply, leads to a real inflation tax. And we saw this kind of crazy inflation in the late 70s as a result of higher inflation and or stagflation, really, because you saw stagnant wages and high inflation. Now, wasn't to the level that we saw in Germany prior to World War II. You saw a lot of hyperinflation going on there because of a number of issues that they were having to try and address, paying back war reparations for the First World War. The economy was really taking a nosedive. You had the money that, because of hyperinflation, the money was basically worth more in heat to actually light it on fire and use it as heat than it did to make any other use as a result of that. So what are the effects of this type of inflation in terms of happening? Well, it's going to create winners and losers. Obviously, if you need the money and you have to borrow it, you're going to pay a much higher rate. You're going to be a loser in that respect. If you're if you're a lender, if you're a bank that's loaning the money out, you're a winner because you're going to loan it out at a much higher rate. And as a result of that, the idea here is that lenders are going to pay more, and it's going to stifle some of those decision making processes when businesses and consumers decide whether to take out a loan. If inflation is rising to the point that it's really having a negative effect on people being able to make the decision to borrow to buy a home or buy a car or get that home equity line of credit, they're going to be less likely to do so. And so that's going to stifle some of the AD that we see in the economy. Now, the difference here is when we get to what we call the Fisher effect. And that is when we look at the expected inflation and the nominal interest rate, essentially what we're seeing is a Fisher effect. If the inflation rate, if the nominal interest rate is actually baked in because it's all inflation, and we know this, the expectation is that it's inflationary, then the real interest rate isn't any different than what it was before. And so it has less of an effect because we know that the real interest rate is unchanged. All of that we are seeing is as a result of inflation. Now, this is a pretty dramatic example because you have inflation basically rising by 10%, and essentially inflation rising at 10%. That's unheard of. I mean, for it to move in that capacity. We've been in an expansionary period for 11 years, and up to and including parts of March 2020, and we never saw inflation at this type of level. You just didn't see it. But the idea here is if inflation were to rise at that respect, and the expectation is baked in that basically the Fed is coming out with the expected inflation, and businesses know this, then the real inflation rate or the real interest rate in this capacity is unchanged, because the idea is, well, if it's a net, if the supply is going up but the demand is going up too, then essentially we're paying what we were paying before. There's no real change in the real interest rate that we are seeing as a result of this. Now, does inflation have an impact on businesses and their decision making? Absolutely, of course it does. The shoe leather costs we've talked about before, this idea of transactions lead you to have to go to the bank, running over to the bank and basically using your shoe leather in your shoes to basically get more cash out because you have to pay the inflation tax. How much more do you have to pay in order to change your menus yet again in order to pay for that? And then unit of account costs. How much is this going to cost us in terms of a reliable measure of value? So there are costs involved, and obviously, not to minimize that, the inflation is definitely not something that business looks forward to. But the idea here is there are a lot worse aspects than a small inflation rate. And that really goes back to the Fisher effect. If you see inflation is rising by 2% or 3% or less than that, there's less concern about that, and it tends to not really have as much of an impact on businesses making a decision to borrow money at those higher rates, because again, the real interest rate is unchanged, and so that's really the biggest difference. Now let's talk for a second about this idea of deflation, a negative rate of inflation, essentially moving in the other direction, where goods all of a sudden, instead of prices rising, the costs actually drop, but the wages drop too. And we don't tend to see a lot of this in modern day. You see more of inflation, and because of the Fisher effect, a lot of those, under 3%, 3.5%, are really baked in. So if inflation is rising by 3.5%, you're not really going to move any minds and make any significant decision changes as a result of that, because people are saying, hey, we understand that that's really the cost of doing business. All right, so let's talk about deflation for a second. And this idea is especially unexpected deflation. If we have debt deflation, the idea is a reduction in aggregate demand caused by deflation. It can intensify an economic downturn. This is only going to happen in periods in which you have a recession or a depression, and this is kind of you're already in a bad mess. This is exacerbating the issue. So that's where you would tend to see that. And again, this isn't something we commonly see or have seen in the last 50 years, if you will, in the United States. Now, that's not to say in other countries you might not see it. In a Venezuela type of situation, or in Russia, for instance, the former Soviet Union, there may be some aspects to that, but the idea is the same in that we haven't really seen a whole lot of this happening, and in terms of its effects. And one of the reasons for that is because the Federal Reserve, any type of federal body, national bank and whatnot, that is looking at interest rates, is also looking at this idea of zero bound. This idea that you don't want to go down to zero, because if you do and then you hit a recession, where can you go from there? You get into what's called a liquidity trap. And Japan had this problem in the 80s and into the 90s. And the only way to get out of it is, one, it's going to take a long time, and two, you're going to have to use fiscal stimulus and spend, even if it means borrowing to spend. Keynesian ideas there. But you're going to have to spend your way out of it, and it's going to take a long time in order for it to take effect. And that's exactly the problem that they had. All right, well, hopefully you found this helpful in closing out our last unit in AP Macroeconomics for the 2020 school year. I hope you found this helpful. Live the 5. I believe in you. Remember to just parse out each particular question and answer. Make sure you're answering every part of the question that's given to you. And I know you will do well. I believe in you. Live the 5. Have a great day.